Welcome back to the panel on monetary policy and inflation. And I'm very happy that we could assemble a highly impressive group of people being responsible for major elements of the analysis, but also of the policy decisions. You saw the list, and just to remind you whom we will have from afar, it's Tobias Adrian from the IMF, who is the Director for Monetary and Capital Markets. We have Claudio Borio from the BIS, the Head of Monetary and Economic Department, and Joachim Nagel, the President or Governor of the Deutsche Bundesbank. And of course, most importantly, very happy that Anna Bailey is here, who took the efforts to come not only in via electronically, but physically. Very happy. Thank you very much for joining us here. This is a panel which is structured around two topics I would like to discuss before opening up at the end to the audience. It has to do, of course, with the inflation and with two aspects of inflation. The first aspect of inflation is, well, why haven't seen it coming? So the question is, what led us that we didn't see the inflation? We know nowadays what may have created some of the inflation dynamics, be it demand factors, supply factors, and they have been around about now almost a year. But still, the first question then is, why haven't seen it coming? And the second part then is, if and as we are now encouraged to act and talking to bankers, talking to the public, talking to journalists, a key question is now, let's move to do more in order to deal with the inflationary pressure. What are the kind of elements which make us less forthcoming that other people would like to have it? On the first topic, and then I will hand over for 4 minutes each of the 4 panelists before we engage in a discussion amongst us. Here the question is, inflation was visible already for some time last year, but still in our projections, in our policy discussions, they did not really take hold in a strong event. And so it was only until early of this year that we really saw, okay, we have inflation now. This begs the question why this has happened. Recall a number of the central banks last year did strategy reviews, changed after a few years or many years, like the ECB, its strategy. And were we so much focused on an environment of low inflation that we could not imagine that an inflationary process there, so it didn't enter our strategic considerations. This is quite an important element there which may have happened. But there may have been other elements there why we did not act, whether and when we could have done so. For example, if you look into the forward guidance, an instrument which was developed over the last years, in our forward guidance, we never considered the possibility that inflation would come from above, inflation would be there. Our purpose was to make inflation to move towards the target. So the idea that the target would be hit from above didn't happen. So given this background, I invite now one of the others on this panel to take the floor. And this time I will start out with Andrew to give his spiel on what happened, why inflation was not part of our discourse only last year, and why it was only taking place this year. Andrew, please.
Well, thanks, Robert, and thank you for, first of all, holding this conference, and secondly, inviting us. It's an absolute pleasure to be here on a very important event. I think you and I talked about this conference about a year ago, if I remember rightly, when you visited me. And we said, yes, it would be very interesting. We probably didn't know just how interesting it would be in terms of the topicality of it. So thank you for arranging this. I think it's extremely important. I mean, as you said, this is a time of very large economic events and shocks, and particularly very large external events and shocks. Obviously, most recently from Russia's invasion of Ukraine. And let's be clear, I say that as someone who wholeheartedly supports the cause of Ukraine and the assistance that we must give and are giving. We are in a period of rapidly rising energy, goods, and some food prices. And it really goes back to the discussion we were having before the break on expectations. These are the most visible prices too. And this is by far the main cause of high inflation, certainly in our case, and is painful, particularly for those less well off. So the obvious question is, what can and should monetary policy do? I think there's a very important distinction to your question, Robert, between whether monetary policy can anticipate and stop the effects on inflation of shocks, and if not, whether it should respond when they happen. Now, I think when events and shocks such as pandemics and wars happen, the answer to the first question has a greater component of no in it, but the answer to the second doesn't change. It's very much yes. Monetary policymakers can and must take the actions needed to return inflation to target over a period that avoids unnecessary volatility in the economy. And it is domestic actions that have to get us back to price stability. So for monetary policy, the choice of policy actions is influenced by the nature of the event and the shock we're facing. If I take the situation in the UK, we're facing a very big negative impact on real incomes caused by the rise in prices of things that we import, notably energy. And we expect that to weigh heavily on demand. We judge the appropriate degree of monetary tightening taking that into account. What I don't agree with and reject is the argument that in our response to COVID, the Bank of England's Monetary Policy Committee let demand get out of hand and thus stoked inflation. I don't think the facts support this. On the latest number, UK GDP in March was only 0.6% above its pre-COVID level, and it is substantially below the path it was expected to follow in the last projection before COVID in February 2020. But what we do have is a very tight labour market, so added to those external impacts. But I don't think that really tells a story of rapid demand growth. What's happened in our case is that the labour force has shrunk by around 1% since the onset of COVID. So there is a considerable impact from the supply of labour. Now, the job of the Bank of England is to return inflation to target at a time when a very large headwind from external shocks and an internal shock from a fall in the labour force is taking place and reducing incomes, but equally risk leading to persistence in domestic wage and price setting, so-called second-round effects. So balancing the immediate effects of these events and the second-round effects. And we will, at the Bank of England, as always, take monetary policy decisions to ensure that the inflation target is met over the medium term. We've raised the official rate 4 times so far, and we've made clear that in order to bring inflation down to target, we are prepared to do so again based on the assessment at each of our meetings. I'm going to finish there, Robert, because I think we're going to come back to some of the follow-up questions in the second part of the discussion, so I'm not going to comment at this point on forward guidance. So I think it's, as you said, it's a very important subject. Thank you.
Thank you very much, Andrew. So from what you're saying is that the Bank of England, that is say, what's not behind the curve, you was always on top, and you followed it much more closely than perhaps others have been doing, well, which showed your early action also on the interest rate.
I think we have raised interest rates 4 times, but I think that doesn't take away the debate, the very lively debate that's happening in the UK on that, and I understand that. What I would say is this: I think when we go back to last year, and I think this is the discussion we are having and should have, is coming out of COVID, we saw a number of shocks and events happening, which we interpreted at the time as supply-side adjustments to COVID. So the shift, what had been the shift from services to goods demand, we've seen some rebalancing of that in the UK, haven't seen it in some other countries. We saw a pattern in the first year of COVID of participation in the labour force declining, but then it recovering in the first, give or take, 6 months of last year. So we obviously at the time have to take a judgment on, well, is that going to continue or not? What's actually happened since then is that it's gone backwards again, and it's mainly gone backwards, I think, due to a rise in long-term sickness. Now, the questions I think we had to address at the time last year were, the word transient has now obviously become, quite difficult. The reason, in my view, it's become difficult is because, of course, we've had a whole sequence of things happen. These events happen. Most recently, I think two things. One is obviously the Ukrainian situation, and the other is the, I think, more difficult situation now in China in terms of supply at the moment. And the problem I think that brings is that when you get, the transient argument really holds when you get a shock, supply shock. You ask the question, which is where the definition of transient comes from, do we think this shock is going to play through in the, within the transmission mechanism of monetary policy, which is often regarded as 18 months to 2 years, but can vary depending on the sort of who's analysing it, or not. Now, I think it's reasonable with individual shocks to think that, but of course what we've had is this succession of shocks between which there are no gaps. And then I think that you have to sort of say, well, transient can't handle that set of things happening.
Okay, thanks for this precision. It's an important one. Let me move on now to Joachim Nagel. Joachim, if you could give your assessment. Of course, you're in a difficult position at a time when this has happened. You are not yet president of the Buber, but I'm sure from the distance you watched it. So what's your assessment? What has happened? Why this wasn't picked up as much as it could be? Was it the transient measure only, which prevented that, or have there been other reasons there? Over to you, Joachim.
Thank you very much, Robert, for inviting me to this event, and sorry that I cannot be in Austria for taking part and having maybe bilaterals with you and discussions with the participants in Vienna. I'm really not so sure if I was really in a difficult situation when I took this new position, because, well, as you all know, that the Bundesbank has not been one of the most eager proponents of sticking to a very expansionary stance. And myself, I have voiced my concerns about rising inflation right after taking office. So maybe I'm not in the best position to answer this question, but let me try anyhow. And maybe you will find it interesting that I will more or less defend the position of the ECB and the Eurosystem regarding our strategy. Because I think the criticism that I hear from time to time regarding the strategy review, I believe, of the Eurosystem is not adequate. Because in my view, it creates a kind of a false dilemma between, in my understanding, two requirements. The first is how to cope with being at the effective lower bound, and that was the case for many, many years, and experience that certainly was a key motive for the strategy. And the second element I see as one important one is handling the situation where inflation is above target and possibly significantly so. In my understanding, in my view, the new strategy gives convincing answers to both. It allows us to deal with the effective lower bound in a much better way than the old framework, while still ensuring price stability in the medium term if inflation is above target. I try to explain this to you in a little bit more, let me say, explicit details. The Eurosystem strategy review of 2020 and last year took place at a time when the euro area and also other currency areas had been predominantly concerned with persistently low inflation rates for many, many years. This is why the new framework includes, for example, an asymmetric reaction function. Despite this, the Governing Council was well aware that the new strategy had to be universal, and this found its way into the decisions regarding the new strategy. the two most prominent examples are decisions on the levels of the inflation target and its symmetry. This inflation target is, in my understanding, only negligibly higher than the policy aim from the previous strategy. So the Governing Council in this time consciously decided against an inflation target higher than 2%. There was a clear awareness and a broad consensus that the higher inflation target and hence higher average inflation rates would entail costs that could outweigh the benefits. And second, this is also important, the inflation target is symmetric, meaning that negative and positive deviations from the target are equally undesirable. And not to forget, on the one hand, this means that the Eurosystem takes into account the implication of the effective lower bound in order to avoid negative deviation from the inflation target becoming entrenched. And on the other hand, crucially, in the current situation, and I believe this is important here, the symmetry of the inflation target emphasizes that positive deviations are equally undesirable. So I believe the new strategy clearly does not neglect upward risk to the medium-term inflation. And on the contrary, it gives the Governing Council also the necessary instrument with the necessary framework to act decisively within inflationary environment and is therefore suitable and applicable to the current situation of high inflation rates. To sum up, I believe we have all instruments that are part of this strategy review that give us also, let me say, room to maneuver, even in a scenario where we maybe underestimated inflation. And I guess we will discuss that later in our discussion, why we were, and we are criticized now for this, why we were so wrong in the past, not to see that there is this change of the inflation outlook. But I believe it is not, the problem is not in the strategy review of the Eurosystem. I think the review is giving us a lot of help to really also deal with such a situation.
Thanks.
End it here, and I guess I have more time to discuss later.
Okay, now thank you, Joachim, on this strong statement that it was not the strategy which, to say, was at fault for having missed the inflation. Perhaps at a later stage, I know you have not been part of the discussion, but we still have an issue with the question of the forward guidance, which how to say, led us to stay expansionary for perhaps a bit longer than it could have been useful. But I would like to move over to Claudio Borio. Claudio, since at BIS you have this strong view of all the main central banks in the world, what would be your answer to my question? What was it from institutional part of it? Why, how to say, we came to a bit too late to discover that inflation, higher inflation, is a clear phenomenon and not only a transitory one, at least for some time. Over to you,
well, thank you, Governor. So let me start by saying that the BIS, just as most central banks and as most observers, we were also surprised by the persistence and the strength of inflation. And as I was saying before to you, we had an exercise in last year's annual economic report in which we tried to had a scenario of high inflation with a number of assumptions, and it turned out that reality even surpassed what the inflation rate that we had envisaged in the scenario. So this means that we need to be very humble about trying to understand, expose what we could not work out or anticipate or envisage ex ante. Now, my sense is that the conclusion that we have reached is very similar to the conclusion that many central banks and many professional forecasters have reached, is that this inflation flare-up is the result of a number of rather COVID-specific or post-COVID specific circumstances, and that we need to bear that very much in mind. Our best explanation is that we didn't quite see it coming because the rebound in demand was stronger that we had anticipated because of the pent-up demand that was there. More importantly than that, the rotation of demand from services to goods was more persistent than we had anticipated. And in relation to all of this, we did not see the bottlenecks coming. We did not see the bottlenecks in the world coming. At the beginning, these bottlenecks were the result of measures to contain the virus, but then they were largely the result of, at the global level, supply being unable to meet demand. And then, of course, we had the war, and no one had put the war in the scenario. And the war, as we know, has been a huge negative supply shock, pushing commodity prices up. In addition to that, there were a number of factors, particularly one factor, I think, that made us think that even if inflation was to rise, it would not be particularly persistent, and that was the fact that the bargaining power of labor compared with, say, what we saw in the 1970s was much weaker as a result of globalization in particular. Now, something that might be useful for me to add, and this is really getting into the more technical aspects, is that what we did in order to build that scenario was to use the Phillips curve, which I think is not the only tool. Of course, central banks and everyone sort of carries out a 360-degree analysis in order to work out where inflation can go. But it is a kind of tool that is very much at the back of our mind when we think about inflation. And indeed, there are a number of aspects of that tool that I think could have led or at least contributed to the fact that we had underestimated the persistence of inflation. Some of them are backward-looking, some of them are more forward-looking as to what might happen in the future. So let me mention 4 of them. The first one is that the rotation of aggregate demand and the bottlenecks that I was discussing before, when one is using the Phillips curve as the framework, they show up in the shocks. And by their very structure, by construction, these shocks have only a temporary impact on inflation. Whereas when we think about bottlenecks in supply and the like, we are really thinking more about what happens to economic slack, at least at the global level, and what happens to aggregate demand in response to, or rather, what happens to supply in response to demand. And this is very much an aggregate demand, aggregate supply story, which should show up, at least at the global level, in economic slack, what's happening to economic slack at that level. And these shocks are more persistent. That the impact on inflation of aggregate demand imbalances is more persistent on inflation than these transitory shocks. The other aspect, and this is related to this, is that what might appear as a supply shock from the perspective of each individual country may actually be a demand shock at the global level. And here there is a little bit of a fallacy of composition. We were talking before about the fact that oil prices and commodity prices were going up, but before the war, that had less to do with negative demand shocks, negative supply shocks at the global level, and more to do with the fact that, again, supply was finding it difficult to meet this strong rebound in nominal aggregate demand at the global level. The third element that I think we need to bear in mind has to do with the way that expectations and the link between expectations, and this is more forward-looking, expectations and inflation is modeled in the Phillips curve. And the key point here is that bygones are bygones in the Phillips curve. So that unless economic agents expect inflation to be very persistent going forward, there is no adjustment in inflation as such. Whereas, in fact, you could have a situation, particularly in the context of negative terms of trade shocks in individual countries, where you might not necessarily expect inflation to be permanently higher, but you're simply trying to recover the losses in purchasing power that you have already incurred. And that in and of itself could generate a wage price spiral because, if you like, when the cake becomes smaller, the fight over it becomes bigger as between labor and firms. And of course, there is a tendency for all of us when we're trying to forecast further out to assume that inflation will return to target. And that in and of itself makes it a little bit harder to get persistent inflation. But the most important point that I would like to stress is the fact that there are no non-linearities in the Phillips curve, in the sense that it does not take into account the possibility that the inflation process itself depends on the level of inflation. And that transitions from low to high inflation regimes may themselves be self-reinforcing. What I have in mind is that once inflation gets out of the zone of rational inattention, when it doesn't have influence on the behavior of agents, and becomes, if you like, goes into the area of what I would call sharp focus, then the dynamics of the inflation process changes. You will start seeing a greater demands for indexation, greater demands for the centralization of wage negotiations and the like, that can make inflation become more entrenched. So, simply put, I think that there were some obvious reasons why we missed it. What is important is to make sure that going forward, we do not underestimate where inflation could go.
Okay. Thank you very much. I mean, as always, when we talk about inflation, Phillips curves plays a main role in the discussion. What we currently see from the point of view of empirical manifestation that in US, yes, there's a strong results in the wage setting, whereas in Europe, and I don't know about England, it's somewhere in the middle. Okay. It's coming down there. That's something I'm sure we'll come back to that. Let me turn now to Tobias Adrian from the IMF, who, looks into the international development from an even larger angle, because it's not only from the monetary policy setting, from financial market sector stability, but also from the behavior for financial flows as well as trade flows. So what is your take, Tobias, on why, perhaps also the IMF has missed a little bit of the dynamics? What is it what the IMF may have underestimated?
Yeah, thanks so much for having me at this important conference, and I apologize for not being in Vienna in person. The primary focus of the framework reviews and the shift more broadly towards make-up strategies was motivated by the challenges posed by very low interest rates. The low and downward trending R* across many economies meant that the higher risk of hitting the effective lower bound was ever present. And so that generated an important asymmetry for policymakers. So being away from the zero lower bound and having inflation that was high enough was very important. The reviews were also motivated by the concern that low inflation was dragging down long-term inflation expectations. That was particularly visible in the five-year forwards, particularly in the euro area, but also to some degree in other economies. And even some survey measures were starting to drift lower prior to the pandemic. So there was this concern that there might be even a de-anchoring on the downside. Of course, now we are on the other side of the de-anchoring debate. I think the third motivation for the change in frameworks was the flattening of the Phillips curve. And Claudio already talked about the importance of the Phillips curve in the thinking. It just became flatter and flatter and flatter, so that there was the idea that economies could be run hot, perhaps without much inflation. That was fairly broad-based. And so it is possible that the commitment to promote a full recovery before liftoff was certainly fueling aggregate demand to some degree. And I think the United States here is different from other countries. And I think Governor Bailey has already pointed out that in the UK, for example, output remains today below pre-pandemic output. But of course, that's not the case in the United States, where output is well above pre-pandemic output. So I think it depends a little bit on what country you're looking at here. So I don't think that the inflationary pressure in advanced economies were caused per se by the money supply that was created, so to say, by these new frameworks. Although away from the zero lower bound, monetary aggregates are associated with high inflation, these are not necessarily autonomous shift in the money supply when you're at the zero lower bound. And when you look across countries, there's actually very little correlation between either narrow or broad measures, such as the monetary base or M2 or so, and inflation realization. So, it is, I don't believe that, so like the increase in monetary aggregates prior to the pandemic per se are correlated with inflation outcomes after the pandemic. So what was already pointed out by all the speakers on this panel is that the supply shocks are the important driver of inflation in the current period. It's the combination of supply bottlenecks and then the additional supply shock of the Ukraine war that surprised everybody. And, that includes the international financial institutions such as the IMF. I would also like to point out that central banks have been facing an extremely unusual confluence of new circumstances, right? There's the cost shock push that is causing inflation, but then there are also massive amounts of downside risks, particularly in Europe, where there is, a lot of downside risk at the moment. Of course, our baseline forecast is still one without a recession, but the odds of a recession, at least in some countries, is fairly high. I would also like to point out that China is slowing down very, very sharply, right? One of the locomotives of growth, in particular post-GFC, is slowing down extremely sharply and way more than what we had expected. So on the one hand, we have inflation very high, but on the other hand, we also have a lot of downside risk. And I think that can be another factor why, seemingly central banks are not acting as fast as what one could have imagined in a sort of like simpler environment with less downside risk. My final point is also about the labor market. I think the emphasis on unemployment outcomes stemming from the framework reviews can also explain the delayed reaction to some degree, because of course labor markets have recovered in many countries now, not fully yet in the euro area, but they are running hot in a number of countries, again, in particular in the US. And that of course is now creating some risks in terms of wage pressures, wage setting, and inflation expectations. And, that is creating some urgency for acting now in terms of interest rates. So let me stop here and turn back to you, Chair.
Thanks a lot, sir. There's a lot of commonality, but albeit I think I sensed a little bit of divergence sometimes about the supply and the demand there, because one of the questions that emerges is whether the supply reaction may have been overestimated or not existing in some of the cases where demand came through either from post-pandemic or coming through from de-saving of individuals. And so it was compared to it was a supply shock. Yes, there was definitely a supply shock as well. But before the war took place, some claimed that it was mostly an inelastic supply, which was hit by a number of consecutive demand shock, just to put this into the room. We said we wanted to have 5 more minutes now in order to enter, subtract, correct views which have been here. Who wants to start out to enter that, or is there a common agreement why things could have gone better, but why we were surprised?
Well, I was going to pick up on what Tobias was just saying on the labour market, because I think it is interesting. I mean, there is an unemployment story, certainly in our case, which is that the reaction of unemployment to COVID was a lot less than we expected it to be. And by the way, we were always at the low end of the distribution of sort of people who forecast it. But what I think's more interesting about what I was saying is, in some ways, that I think the story now is much more about participation than it is about unemployment. It's much more about the size of the labour force, why people have decided to withdraw from the labour force, and what we conclude from that in terms of their future intentions. Now, I think there are a number of factors there that come into it. I think, as I said, I mean, if you look at the precise things that are going on in the UK, actually long-term health is one of them. There has been a build-up of saving, and it is possible that part of the withdrawal of labour supply has been a decision to live off that long-term saving. The question then is, what happens next? Is it going to lead to people coming back into the labour force when that runs out, or because they're more distributed towards the older end of the labour force, have people taken what I might call a lifetime decision to retire earlier? In which case they're not going to come back into the labour force. So I think, the whole question of participation in the labour force, which I think probably historically we have not spent anywhere near as much time on. I mean, Claudio is probably an expert, he has the sort of historical ledger, as it were, of central bank thinking, is relevant here.
Okay, and that's an important point what we had before. So when Brandan gave his speech, saying that there also long-term care will block a number of labor force supply there, even if it comes up, but then we have to work on the labor supply there. Joachim, Claudio?
Yeah, maybe, Robert, if you allow from my side some additional comments, and maybe I'm trying to be a little bit more critical with ourselves. What is the role of the central banks? Where's our responsibility? So price stability, this is our mandate, and I believe the next months, years that we will entering into a very complicated discussion. I will not say that there is a blame game, who is more or less responsible for what and why it happened. So, but I believe at the end, it seems to me too easy to just say, well, this is a matter of a supply or a demand shock. Yes, it's definitely this is a supply shock. In some, countries, there came on top a demand shock. Then we went through a pandemic situation, and then now this horrible war. But I guess at the end, it is, for me, it's too simplifying the whole thing. We have also to realize that our monetary policy over a decade was very, very accommodative. So just saying this for the Euro system, we are now in a situation where we have excess liquidity of more than 4 trillion euros. I guess we're coming close to 5 trillion or something. So this is really huge. So we shouldn't forget this, that we did a very, supportive monetary policy over a long period of time. So isn't it such a surprise that after such a long period, we are more or less entering into a period where inflation is coming back? So we should be a little bit more critical here with our own role, what we did over the last 10 years.
Thanks, that's an excellent addition, which I can pass on then to finalize these rounds to Claudio. What Joachim alluded to is that money matters for inflation. So would you subscribe to that, Claudio?
So I would say a couple of things on that, and let me go back then to the demand-supply story. On the role of monetary policy specifically, well, it's clear that monetary policy tried to push inflation up very, very hard before what we have seen now, and it was very hard to get it up. Okay, so I think that to say that monetary policy, I'm sure no one is saying that monetary policy has been the reason why we have seen inflation going up recently. I mean, clearly it was not the main driver. But of course, monetary policy may or may not accommodate the increase in inflation. And here is the key role. To what extent is monetary policy accommodating it? And to what extent should monetary policy respond to it? And this is really the core of our debate. On the demand and supply thing, I mean, going back to, I think it's important to make a distinction between what may be happening at the level of individual countries and what may be happening at the global level. And clearly there are a number of individual countries in which, demand is well below what it would otherwise have been. But the key point I was trying to make was that after an initial phase, at the global level, output of various commodities and of various other sort of inputs was higher than it had been. The output was higher than it had been before the crisis. And that even looking at the output itself, so that would suggest that demand was a key factor. Whether it is the level or whether it is the speed at which it increases, it's clearly a factor. And sometimes it could be misleading to look at what happens to the output to the level of real output in order to work out whether it's demand or supply, because at the end of the day, I mean, take the extreme, if supply doesn't respond at all, the increase in demand is going to show up in prices, it's not going to show up in output. And in fact, some work that we have done here with colleagues, some of it will show up in the annual economic report, does suggest that this distinction between nominal and real is important and should be at least taken into consideration.
Okay, thanks a lot for this addition. I think we finish now this first round and move to the next round, which is the question that... Who? Tobias, sorry, Tobias. I see the screen not well for this reason. Thank you. Tobias, please.
So the one addition I would make here is central bank credibility and the role of central bank credibility. So in the economies that are of focus here today, advanced economies such as the Euro area, the UK and the US, central bank credibility is very strong. And so traditional monetary theory tells you then that you can look through some of the supply side shocks, especially if they are expected to be temporary. And that, of course, was the situation as Claudio and others explained. The situation is very different in emerging markets. So in emerging markets where credibility is less well anchored, you cannot just look through supply shocks. And indeed, emerging markets were much earlier at tightening, right? Because they cannot trade off inflation versus real activity as well. So because they don't have the credibility, they tighten much more early and much more aggressively. And when you look at the inflation forecast, so inflation is very high in countries like Brazil or China or Mexico at the moment, but it is expected to come down very quickly when you look at the forecasters. And in advanced economies, of course, because you have more credibility, you don't need to be as aggressive in terms of tightening. So it gives you an additional degree of freedom, basically. And I think that's a very important element here. And the key question now is whether there are any signs of unanchoring. And that could be in the labor market, that could be in surveys. I've looked recently at household surveys, and you clearly see a sort of like bimodality, where some households expect very high inflation to persist for many years. And this bimodality is quite worrisome in terms of thinking about credibility and anchoring. Let me stop.
No, thanks for this important addition, which actually leads quite perfectly now to the second round there, to the question around why did central banks, at least developed economies with high credibility, we assume, not act as forcibly as it has and is currently expected? Because talking to bankers in the country and outside, talking to the public, the journalists, the question is, why haven't you yet acted? And when are finally going to act? It leads to the question why this is happening. Taking what you said, Tobias would say, well, the rich country economies with credible central banks don't have to do it so quickly. They have the credibility, can wait, they still be able to achieve this goal. This would be one answer that could be given following your suggestion. But what else could be said why central banks haven't acted as strongly? Does it have to do, just a few ideas, because there is this uncertainty about supply and demand, and different questions when to act on the supply side and on the demand side. On the demand side, yes, one could act quicker. If it's on the supply side, one is a bit more resistant of doing it. Does it have to do with deep-rooted historical, perhaps drivers there, which make some central banks act as forcefully, or does it have to do that perhaps the governance frameworks matter, so that the composition of the monetary committee in different central banks have a different effect, why things happen? If you have a smaller monetary committee, you can more easily come to a decision, but if you have many people deciding there, it is more difficult to come to a compromise or to some kind of policy decisions there. Or is it that, no, it's fine, we are just on the spot, we will act now and everything is fine. So the question of, is there something which led central banks not to come forward as quickly as it could have done, or did they come forward? So this is the kind of question I want to put into the air. And this time, anyhow, I wanted to come with from the national institutions towards the governors. So Tobias, since you are still in the spot of the camera, may I ask you to take the lead on this one, please? Thank you. And then Claudio, please.
Yeah, very happy. So I think what advanced economy central banks are trying to engineer is a soft landing, i.e. Some slowdown in real activity that gets inflation back to target in a reasonable amount of time, right? So there is a trade-off in between real activity and inflation, but also with financial conditions, right? So by going, somewhat in a somewhat gradual manner, you can sort of like mitigate the downside risks. And there's always a trade-off that central banks have to balance. I think if there are more outright signs of de-anchoring, at that point you don't have that luxury anymore, right? At that point, what you have to do is to be much more aggressive, and you cannot worry about the downside risk, the potential recession. And that's exactly what we have seen in the emerging markets, right? In emerging markets, the output gaps relative to the pre-crisis were much larger, magnitudes larger than anything we see in advanced economies. And nevertheless, they said inflation, de-anchoring and inflation credibility is the number one concern. So they tightened, even though that might have adverse consequences on real activity. And when you have a central bank with much more credibility, you don't have to trade off as aggressively. And the second factor, of course, is the slowdown due to the war and due to the Chinese slowdown, right? I mean, there are other forces that are generating slowdown anyway, right? And so that's where the trade-off, I think, is really important. And then I would mention one last thing, which is financial stability, right? We have seen equity markets come down close to 20% in the US, about 15% in Europe year to date. So these are very dramatic adjustments, and we might see quite a bit more going forward as monetary policy is tightened further. The good thing is that the tightening of financial conditions has been orderly so far. So markets have come down, rates have come up, but we haven't seen the kind of dash for cash that was present in 2020. And I think that's another risk that central banks are trying to minimize, is to trigger another dash for cash. So having a somewhat more gradual approach can help you to engineer soft landing, can help you to avoid the disorderly selling. So, price adjustments are fine. Financial conditions have to tighten one way or the other. For monetary policy to act, financial conditions have to tighten. But ideally, you would like to do that in an orderly manner. And so those are, I think, two reasons why you do want to tighten, but in a way that is, somewhat measured relative, say, to a Brazil or so.
Okay, thanks, Tobias. Claudio, do you subscribe to that, or what are the kind of additions or subtractions you want to do on this topic?
Well, first of all, the key point, the first point that Tobias made is absolutely right, in the sense that circumstances differ across countries. The policy response differs across countries. And the fact that emerging market economies, not all of them, but some of those in Latin America, for example, have a history of higher inflation. Financial markets react very strongly. The exchange rate depreciates very strongly. Commodity prices, particularly food prices, are a big part of the consumption basket. Because of all of these reasons, they have reacted earlier and they have reacted more. It is, of course, still the case, and this is a simple fact, that if you look at real interest rates across the world, they have been following pretty much the same path as they did following the first oil shock in the early 1970s. They have become more negative. And they are, of course, expected to converge and become more positive going forward. Now, what factors explain this? Let me add one factor that I don't know how much it has contributed these days, but I think it's something which we should keep in mind, is what I would call, we know that at turning points, in general, there is a tendency for central banks to wait and see a little bit longer than they would do once the tightening cycle has started. And I think that partly reflects what I would call reversal aversion. And it's the concern that if they were to reverse policy, then their credibility might be at stake, or at least might be undermined. I think this is a bad reason. I understand it. This is a bad reason, though, and to the extent that that has played a role, I think that it would be important for central banks to reflect on this and to try and condition financial markets and condition external and other observers not to treat these reversals as mistakes, because they need not be mistakes. They're simply the fact that circumstances change, the picture changes, and you adjust. So I think this is sometimes a source of inflexibility that requires a lot of communication on the part of the central banks to try and avoid. But beyond that, I mean, what Tobias said is definitely the case. I mean, there are very specific circumstances that need to be taken into account in the current situation. We were all surprised by inflation, and that's the first factor that we should not forget. Secondly, there are different views and legitimate views about how persistent the inflationary pressures are going to be, for all the reasons that we discussed earlier. How much of it is supply, how much of it is demand. And then the third point that was made by Tobias, I think is very important. It's the fact that also we are in an unprecedented situation when it comes to financial markets, when it comes to the levels of debt across the world. They are at a historical high, which means, and financial markets have been taking a lot of risk for a long, long time, which means that first, there could be a sharper tightening of financial conditions that might have been the case in the past. And secondly, that tightening of financial conditions could have a bigger impact on economic activity, aggregate demand and economic activity that it had in the past because of the background financial conditions that we face. I mean, if you look historically, this is the first time that we are seeing a rise in inflation, significant increase in inflation, coupled with this type of financial vulnerabilities that I was mentioning before. Until the early mid-1980s, it was basically inflation going up, central banks tightening, that was the main cause of recessions. Until after that, leaving the recession aside, it was mainly financial booms turning into financial busts, with inflation being relatively stable. Now we're finding ourselves in this unique situation, which is creating additional challenges, whereby higher inflation, part of it driven by supply side factors, which tend to repress economic activity, is coinciding with high debt levels and financial vulnerabilities, particularly outside the banking sector.
Okay, thanks, sir. Thanks for these important additions. Joachim, can I get your take on why perhaps we were waiting too long, or are we just right?
Thank you very much, Robert. I think this is the $1 billion question. I think we shouldn't forget that there were some institutions, including the BIS and other others, that really highlighted at a rather earlier time that there is the danger of inflation. So we shouldn't say, well, there was nobody out there that didn't see that there is maybe something coming. And I would like to make maybe two very general points. I think the first one, it seems to be obvious that it is much easier to lower interest rate than going up with interest rates. And I guess Claudio already alluded to that. At the turning point for hiking rates, this is very complicated for central banks. And the second general point I would like to make, this is my anecdotal evidence being just 5 months here in that new role. It seems to be also rather obvious that there is kind of a asymmetric distribution of how to weigh arguments in the same way we use the arguments for lowering rates than in comparison for hiring rates. So we should also think about this, that often it seems to be not balanced here. And maybe a more precise point I would like to put here is we should also think about the signals we received from our models. I think all the models, or some of the models we use that give us a little bit an indication, a forecast where inflation might go over the next 1, 2, 3 years, they were not precise, to say that in a very polite way. I think some of the models, they have not the capability, it seems to me, to deal with structural breaks or with a sequence of shocks. So I believe also we have to think about this, how to get better here. And I believe that is maybe one of the lessons learned out of this period of, let me say, having a situation where we move from a very accommodative monetary policy into a phase where it seems to be the case that there is a turning point together with shocks. Yes, it is true that were really complicated situation, having the supply shock, having maybe in some countries also on top of that a demand shock, then the war. But nevertheless, also the analysis was maybe not, or some analysis we received from the models that were maybe not the most perfect one.
Okay, thanks, sir. This brings me then to Andrew. You were early to react to say you had the session, I think 4 changes by now, what?
Yeah.
which is quite impressive, which allows different interpretation. I'm curious which ones would like to give. Is it that say you as a central banker knew what to do and so you moved on there? Or does it put you into the category was discussed before, you had to react, there's no other chance there, or what is it? How would you describe it?
Well, I should say that quite a bit of the commentary in the UK at the moment would not suggest that we had tremendous foresight, but we have increased rates 4 times since right at the tail end of last year. I mean, first of all, I agree entirely with what Tobias said about trade-off. I think in UK, continental Europe, that's the challenge we face. I've used the narrow path analogy, and it is a real challenge. I think Claudio is also right in his interesting comments about reversals. But picking up what Joachim was saying about this is the moment to be sort of, to be reflective and self-critical, and it really is. I mean, it's interesting in the UK. So, on average, since the global financial crisis, we've more or less exactly hit the inflation target. I think it's interesting, and it's sort of, it's important, don't get me wrong. Very important, but the shocks have got bigger as time has gone on. I mean, across the whole 25-year history now of the Monetary Policy Committee, the shocks have undoubtedly got bigger as time has gone by, and we're now in the period of the largest shocks we've ever faced. So I don't put too much emphasis, and I think we shouldn't be complacent about the fact that we've hit the target on average. And our task now, of course, is to get inflation back down to target without undue damage to output. I think where I do question is the role of forward guidance. And it is, something that we actively debate. I think we're in a world of course, unusually high uncertainty at the moment. I mean, it's always tempting for central bankers to say the world is more uncertain than ever, over and over again. Sort of it's in our genes, as it were, I think. But the world really is very uncertain. I mean, it really is very uncertain at the moment. And I think we have to be pretty cautious about how we can use forward guidance without getting ourselves into a situation where we have to take it away, reverse it. I would, in a difficult situation, I would also say that I think it's easier to put it into place than it is to take it away. It has a tendency, to stay around, and then you think, I'd quite like to sort of, move on. How do I do it? By the way, that's not a particular comment about the current situation. It's a generalised comment before anybody reads too much into what I've just said. I'll say that. But I think we have to be, quite more humble about forward guidance, honestly. Let me finish on financial stability. I take everything Claudio said. I would say it's interesting in our case. Take his point about markets entirely. The household balance sheet situation in the UK, and by the way, I'm talking about the average here, so I will preface this by saying that, of course, there are people who are in a very difficult position. Of course, I don't want to sound in any sense insensitive or complacent. On average, though, household balance sheets are stronger, and they are more robust to shocks than we had in the past. And I think certainly that has quite a bit to do with what we collectively have done on financial stability. And it underlines, the last thing I'll say, it underlines why financial stability is so important and why it sits alongside monetary policy. They're not they're not separate universes in that sense.
Okay, thanks. We are, I think at the moment, would like to invite you to take the floor and state the name. The question we'd like to ask linked about our topics, to whom it is directed, so that people know what to answer. We take a few rounds together, 3 or so, before we move on with the answers.
Andreas Grünbichler, my question is for Claudio in Basel. He was talking about the Phillips curve and that the BIS uses it as a model and as a tool in the inflationary environment. I'm just wondering, just hypothetically, if we assume a stagflation scenario, what kind of tools and models would you apply then? Thank you.
Thank you. Yes, please.
I'm Flamon Rasoy from Central Bank of Kosovo. Sometimes lawyers can make a long question, but the main reason is to get a short answer. In this case, the inflation is different. I mean, the DNA of inflation is different from the traditional inflation because it's composed also by geopolitical interference and post-COVID crisis. I wanted to make a questions related to which is the more adequate actions or reactions that central banks have to undertake or to do. Is it a traditional economic reaction like a monetary policy, price stability, or do we need to do any substantial legal change in order to face with those situations? Thank you.
Okay, thank you. And David, please.
Yes, thank you. David Marsh. I've got a couple of questions for Joachim Nagel, if I may. One on the issue of models. You made some remarks about the ECB model. Would it be an idea to expose the ECB model to some outside review by a neutral international body like, say, the OECD or the IMF and get them to come up with some reasons why the model might not have worked very well over the last 10 years? And then the second point regarding the expectations. We heard a lot about this. Claudio said very interestingly that we seem to have a window of opportunity before inflation becomes self-reinforcing. I somehow interpreted his remarks. He said we have to use this zone that we're in while the interactions still remain rational. What is your view, Joachim, of the wage demands at the moment in Germany? People seem to be very sensible. The wage bargainers seem to have a legendary common sense. Will that continue, do you think? And is this more because people open their newspapers and look on television and they see the danger of a recession or they see the danger of gas being cut off? Is it more that, or is it because they read Philip Lane and they say everything will be okay because we're going to go back to 2% in the long term? Is it more the brute force of the real economy rather than central banks and their so-called anchoring activities?
Thanks, David. Joachim, I'll let you reflect on this and I give first the floor to Claudio with regards to looking at the Phillips curve, okay? Claudio.
Okay, thanks. But by the way, when I said we use the Phillips curve, I mean, we used it as a tool to try and create this scenario of higher inflation. You need a tool in order to order your thinking. I think that the Phillips curve can be useful, particularly in an environment which is very, very stable over time so that things don't change. I think where the Phillips curve is not useful, which is why I think it's very good for central banks to have a 360-degree analysis of what goes on, which is what they do all the time, is when you get these transitions. If there is something that I would like people to take away from my presentation today, is transitions between low and high inflation regimes. These transitions are self-reinforcing, and low and high inflation regimes are very different animals. When inflation is low, very low, as it had been for a long time, most of what we measure as inflation is the result of largely idiosyncratic, relative price changes that tend to have a transitory impact on inflation. When inflation is high, the common component of inflation is much, much higher. And when inflation transitions from a low to a high inflation regime, things are not stable. And there is a kind of tipping point. There's a kind of self-reinforcing process that by its very nature is not captured in typical models that we use that are based on long-term regularities as opposed to transition points. So by the way, we don't use the Phillips curve in particular. There is nothing that the way that we look at things has to say about the cost of stagflation, except to the extent that wage price spirals, aggregate demand is only one influence on our economic stack, on wage price parallels, on pricing power of firms and the pricing power of labor. Structural factors are also important, and we need to pay attention to those. And let me just say something about what I think David mentioned. Should we have an external review from the IMF and the OECD of the ECB model? I don't think that it will take you very far, because all of these models are very, very similar. I would not advise that. But
Okay.
one final thing, if I still have the floor, I couldn't agree more on what Governor Bailey said about forward guidance, and I think one could expand and elaborate on the points that he made. But it goes back to the flexibility that we're talking about, which is so essential in monetary policy, and that over time, I think central banks have been giving up little by little.
Okay, that's definitely a point to elaborate on, but not in this session, the role of forward guidance in the future. Joachim, you had already one answer taken away from you, unless you want to contest it and say, well, it makes sense. But there was a second question also to you.
Yeah, thank you very much, Robert. I think, first of all, when I saw the camera moving to the audience, I really regretted that I'm not there. So when I saw so many familiar faces, Oriel Schubert, and I saw also Ewald Nowotny, so my best greetings to all of them. And sorry for not being there. But coming back, first question, and so Claudio, I guess he said the right thing, but I believe nevertheless it is important, I think, for all the models we are using, that there is a checks and balances. And I believe, I'm not sure if an outside review is necessary there, because the ECB, they have so many excellent researchers, and I believe they will do that on an internal capacity basis. So I think this is, but I believe it is necessary. And the second question regarding wage bargaining, David, I think I'm not sure if the people are listening to Philip Lane and so on, but I guess there's a much more, let me say, much simpler explanation. I think when the people are going to the supermarket and they see how the prices went up over the last 12 months and taking the German numbers above 7%, I think that was crystal clear from the beginning when I was part of that discussion. I said, well, that is not a surprise when the unions are coming up in such a situation and asking for higher nominal wages. So definitely, I will not say that it's ending up in a wage price spiral, but it seems to be clear that the wage moderation we saw over 10 years in Germany, this time is over now. And I think this is a more or less a natural process that is coming out of these high prices. So it seems to be the case. We shouldn't be too reluctant here that relief might come from the wage negotiations. I believe that in the second half, when all these wage negotiations, normally they're starting in the second half of this year in Germany, we will see high numbers coming from the wage negotiations.
Okay, thank you. I hope, David, you are satisfied with the answer. There's no second question for you out of it. Andrew.
Well,
yeah.
I was going to give David a bit more of an answer, actually, so
Okay.
he may be less satisfied after I mean, I think it's interesting, David. I look at that question. I mean, in our case, I think that question's been around for the whole life of the MPC, actually, 25 years. And I think the question is, what do we use the model for? I think if you did a sort of, blind test of models, you'd get results, but then we'd say, well, that's actually not how we use it, though. It's not a sort of, machine that you sort of feed the data in, turn the handle, and out pops the answer. What it does, and we also use several models. What it does do, I think, is it's one of my, sounds a bit diminishing, really. It's an adding up device, but it's also a consistency tool, I think. I mean, it does obviously prevent, inconsistent things being done across different parts of the landscape. But it's always open to us as we do to then say, well, we're going to impose a judgment into it. So, I mean, we did this time. I mean, the report we published at the beginning of May, because going back to what I was saying earlier, we'd had a view on participation in the labour force returning to its sort of long-run average. And we just said, honestly, we lost faith in this, actually, and we all essentially then reduce the sort of the return of participation. That's not a model judgment. That's us saying to the staff, pop that in the forecast. You get the model to do what we want it to do in that sense. Insofar as the model, of course, is, as I say, is a sort of adding up device.
Okay, thanks, sir. I see no other hand up. Yes, sir. Ewald, yes, we see 2 hands up. Thank you. 3. Okay. These are the final round.
Thank you. Just a question concerning financial stability issues. As has been mentioned before, we just now see a very fast and in some way even dramatic reactions on the capital markets, both in US, but also to a certain extent here in Europe. The question is, isn't this an argument to be rather careful now with this notion of a kind of financial financial tightening, so that reducing the balance sheet, as it is going on in the US, and as I think we should look at this discussion with great care from the European side. Because if things get rough on capital markets, it's always very difficult then kind of to stop evolutions and to stop events that might tend to be irrational.
Thanks. Let me move immediately to the next question.
Thank you. Franz Nauschnick, 2 questions. First question, Bank of England, didn't you have an additional shock? You had the Brexit shock on the labor market, but also some border problems. So you were in a worse case than all the others. A second question is, isn't it a problem when you increase, after a big crisis, interest rates very fast? Your economy could fall back, and it was mentioned, into a recession, and your credibility, you lose a lot of credibility if you then have to reverse course, as the ECB had to do after the global financial crisis, when we increased interest rates and had to lower it soon because our economy had fallen back into recession. Isn't this the worst case outcome for credibility?
Okay, thank you. Last question. None. Andrew, please.
Brexit, yes. Interestingly, when I was talking about the fall in size of the labour force, as far as we can tell, whatever contribution there is from Brexit to that, it's not actually at the moment a particularly large one. A much bigger contribution is the domestic labour force shrinking. But generally on Brexit, I would say, and I said this last week to the House of Commons committee, I mean, we have had an assumption in our sort of projections and forecasts for quite a long time, actually, that there would be a negative effect from Brexit, that there would be a trade effect, and some labour supply effect. I think we are seeing some trade effect. The trade share of GDP in the UK, I think, has declined. But my conclusion on that is it's not out of line with what we were expecting. So we haven't changed our view on Brexit in that sense. On reversal risk, I mean, this is the narrow path point. I mean, this is why I think we have to, certainly I can only talk about our situation. We have to be, we have to be careful, and we have to take these decisions at every, meeting by meeting, which goes back to my, why I don't want to overuse forward guidance, because this narrow path is a challenge. And I think the challenge we have is this: we have a big real income shock. We have high inflation on one side. We have a risk of a recession on the other side. I say risk just to emphasize that because our forecast technically didn't have a recession in it. But the risks to inflation are, as we said in the report, on the upside, and they come from 2 things. I think one is the labour market, and the other is the hangover of saving from COVID and exactly what what contribution that's going to make. And again, you know, one of the problems we have in this situation at the moment is we have very little to go on about how households are going to use those savings, given the nature of the way in which they arose.
Okay, thanks. I think this was already the beginning for the final round reversal. No,
maybe Robert, the question of
yeah, it comes to you exactly. Okay.
Yeah, maybe if you don't mind. So, I think this is a very important one. Is there maybe the danger that in such a situation where the uncertainty is high and it might end up in a market turmoil or something like this? But nevertheless, when inflation rates are as high as they are, it seems to be obvious that the mandate is more or less the dominant point here, and we have to fulfill what central banks have to do in such a situation. We have to withdraw the monetary stimulus, and then at a later stage for the euro system, we have to hike rates. But what I believe is of utmost importance is to give financial markets guidance and orientation. So clear communication is absolutely important here. So this is reducing uncertainty. We have to really give them the clear picture, what is our intention. And so it's very much appreciated what Christine Lagarde did today when she came out with a clear communication. I think this is important in a situation like this. That is a common understanding, I believe, in the Governing Council. And so from my side, I can say this was the right step forward to reduce uncertainty and also this is also helping financial stability.
Thanks, sir. I think this fits nicely. Then handing over on the big question of, it's another form of further guidance, not the one which you have the self-binding, but the one which you try to inform the market about your intention. Claudio, and then Tobias, if you could close on the question of reversal, danger there, and on the issue of importance, forward guidance, communication.
Okay, so on the question of financial market overreaction, instability, as I mentioned earlier, and I think this is fully consistent with what we've just heard, central banks have a mandate. They have to fulfill that mandate. And they should take financial conditions into account to the extent that they influence their ultimate objectives. And therefore, to the extent that financial conditions may respond in a particular way, which is very difficult to anticipate, and you have to take that into account when you calibrate your policy, both ex ante and, I would say, ex post. One aspect which I think is important is whenever you exercise that judgment, to avoid over time falling into the trap of what's been called financial dominance, whereby you cannot really move because financial markets have already boxed you in. And here, I think another point which is important is if you want to also to reduce that, quite apart from communication and the like, it is important to make sure that the financial system, infrastructure, if you like, the financial system as a whole is properly regulated and will reduce the need for you to intervene, for example, to stabilize markets, particularly at a time when you are having to tighten, which could send mixed signals. And what has happened since the crisis is that there has been a lot of good work done on the banking side, which has become much more solid, as we know. It's not completely out of the woods. There could still be shocks, but at least has improved quite a lot as a result of higher levels of capital and so on. But where regulation has been lagging is in the area of the non-banks and non-bank financial intermediary sector. There is quite a lot of work going on in at the BIS, but within the aegis of the Financial Stability Forum. And there, as we know, there is a bit of a tension between how central banks see things and how securities regulators see things, because financial stability is not really part of their their mandate. But that's an area where clearly, well, things are going to be slow moving, but it's where we need some urgent reforms.
Okay, thank you, Claudio. And over now to Tobias. You have the final word on both topics.
Well, thank you so much. And I wanted to come back to this question of how we use models in central banking. And I think one way to think about it is that there's a baseline, and the baseline is typically fairly linear, right? This is typically coming out of fairly simple models. But then there's a risk around the baseline, and the nonlinearity that we have discussed so much in this panel is about the risks around that, fairly linear baseline. So at the moment, I think for most countries, the baseline is that real activity is going to slow down, but not necessarily triggering recession, that inflation will slowly come back to target, and that financial conditions are going to tighten in an orderly manner. And I think this baseline is sort of like our wish for how the future is going to evolve, and we have a good shot at it. But then there are massive risks around the baseline, and this is about nonlinearity and about sort of like a confluence of adverse shocks that could occur. So I see nonlinearities in three directions. So number one, inflation might be higher than what we expect, more persistent than what we expect, and potentially signs of de-anchoring might emerge. I think Joachim talked about the labor market wage setting in Germany. When you look at inflation surveys, you see a lot of bimodality, which is always very, very uncomfortable and a sign of a turning point. Of course, in emerging markets already, we have sort of like a lot of worries about the anchoring. So this is on the inflation side. There's the baseline back to target, and then there's the nonlinearity of the anchoring. Secondly, on real activity, there's the baseline of a soft landing, but there's a massive downside risk. And I think the global backdrop here is important. China is slowing down. Claudio mentioned the high debt levels, right? Debt levels are very high in emerging markets and developing economies. So there might be, not a systemic global debt crisis, but there might be some debt, more debt stress in a lot of pockets. Of course, there's the war in Ukraine, which puts a lot of pressure on real activity as well. So the baseline is one of slowing, but the downside risk is very, very fat and tilted. And then there are financial conditions. So we hope that the path towards tighter financial conditions is going to continue gradually, but there's the risk of an abrupt and sharp tightening of financial conditions, a disorderly tightening of financial conditions. And so as a central bank, I think you want to give the right steer in terms of staying on the baseline, but also talking about those nonlinearities that are giving rise to the risks around the baseline. And at the moment, unfortunately, we have much fatter tails towards a stagnation scenario than we are used to. Let me stop here.
Thanks, Tobias. It was a perfect ending, also putting this in the analytical context there. I think we had a great panel, and I think we should give them a hand.
I think we should say thank you, Robert, actually, for such a great set of questions and organising it.
Thank you. Tobias, Claudia, Joachim, thanks again for joining us from afar. Next time, I hope it's possible to lure you over to Austria. The Wiener Schnitzel is still good, so don't worry about this one. And the prices have gone up, I have to say that. Okay, so thanks, sir. Wish you a good evening, and until next time. And Andrew, have a good flight back home, and thanks for coming.
Thank you.
Thank you very much.